Hi guys, please like, share and subscribe. And if you want full course for any actuarial subject, visit theactuarialguy.com or WhatsApp on this number. Thank you.
Hi. In this video, I'm going to discuss the difference between different types of insurance contracts, namely life, general and health insurance contracts, and take an actuarial point of view to it. This video thus becomes very important from an interview point of view. So let's dive right into it.
Okay, so now let's just talk about the different types of insurance contracts. And as you might know, insurance can be broadly divided into three types of contracts. One is general insurance, the other one is life insurance, and the third category is health insurance. Health insurance has characteristics of at some level both life insurance and general insurance. So it's somewhere in the middle of the two, but you will broadly find the classification to be between these three. And in any country, you will find various insurance companies which would be specifically dealing in either general insurance, which is also called as non-life insurance, or in the US and Canada, it's called as property and casualty insurance, which is often abbreviated as P&C, life insurance, and then there will be companies which would be offering health insurance. Okay, so let's try to understand how do these contracts differ, and what is it that they try to insure, and what is the nature of these contracts. So first of all, what is insured under general insurance? Usually it's any form of property. Okay, now this property can be the household, or basically the house. It can be the contents of the house. For example, contents of house are insured against any natural disaster, against theft, against fire and all of those things. Again, house is also insured against any sort of natural calamity or fire or things like that. You have something called as automotive insurance, right? This is fairly common. Others include cargo insurance. So a lot of transportation companies have their cargoes insured by general insurance companies, so that if the cargo is lost due to any sort of accident, that can be provided for by the general insurance contract. They will be indemnified for whatever loss that they suffer because of the loss of cargo. So these are some examples of general insurance. Other examples can be device insurance. For example, your mobile phones, your laptops, your tablets, all of these things can be insured. In manufacturing companies, usually their stock is insured. They buy insurance for their machines, whatever assets they have. So any form of asset that you have can be insured using general insurance or property and casualty insurance. Okay, under life insurance, it's mostly human life that is insured. Okay, and under health insurance, it's usually medical expenditure related to human life that is insured, right? So if someone is admitted to a hospital, and usually generally health insurance companies would have a clause that if the hospitalization occurs for more than 24 hours, this is a clause that is included, then the hospital bills with some terms and conditions is paid by the health insurance company. So now let's talk about the nature of these contracts. How do these contracts differ in terms of their nature from an insurance company's point of view? They're actually very different. So let's talk about the duration of these contracts. Typically, general insurance and health insurance contracts are called as short term contracts or short term business. Okay, so this is also short term. And while the duration might vary, typically the duration of the contract is 1 year. So what an health insurer would tell you is that your medical expenses for a given year are covered by the health insurer for a given amount of premium that you pay to them. So the contract is supposed to be renewed annually, right? And a particular contract only pertains to 1 year, right? Similarly, for general insurance companies, whenever you buy non-life insurance or general insurance related to, let's say, your vehicle, that is your car or your two-wheeler, or for your mobile phone, the contract is mostly only for 1 year. It can be longer, it can be slightly shorter, but at the end of the day, it's a short duration contract. Life insurance, on the other hand, is typically a long term business for insurance companies. Okay, reason is that when they say sell contracts like whole life insurance or endowment assurance policies, these policies last a very long time frame over the entire life of a person, and that can last up to 20 years, 30 years, 50 years, so on and so forth. There are shorter contracts under life insurance as well, such as a term assurance contract can be much shorter, but typically these also tend to be long, like for 5-10 years people can buy term assurance covers. I'll talk about the specifics of life insurance contracts shortly, but a key difference is that these contracts are typically for just 1 year and these contracts are typically for a longer duration. Okay, so their pricing and their reserving tends to be very different. Okay, so now let's talk about the implication of the duration of these contracts onto the modeling of the cash flows of these contracts, and what is an unknown variable and what is a known variable under these contracts. Okay, so when I go to general insurance, let me discuss general insurance first, because we are going to discuss life insurance in a lot of detail anyway. So under a general insurance contract, and this is not covered in CT5, this is covered CT5, that is CM1, this is covered under CS2. Okay, which it was earlier covered under CT6 under the old curriculum, now it's under CS2. Okay, so under a general insurance contract, what happens is, since it's a 1 year contract, let's take an example. Let's say a general insurance company issued 100 policies ensuring identical mobile phones. Let's take an example. Let's say 100 Samsung Galaxy S21 phones. Okay, for the year 2020 to 2021. Okay, so their policy is it's a very simplified example, are going from 1st April 2020 to 31st March 2021. Okay, now out of these 100 Samsung Galaxy S21, there can be different types of losses for each of these phones. So some people can end up breaking their screens, For some people there can be a liquid damage. For some other people there can be damage where their backs shatter. So there can be different kinds of claims, okay, and some people might not have any claim, okay. So out of these hundreds, what is the uncertainty, okay, for the general insurance company? We do not know what will be the number of claims that will occur, and we don't also know what will be the amount of claims in that year. Both of these are treated as random variables under general insurance or P&C insurance contracts. So the number of claims, like how many mobile phones will end up into a claim, is a random variable, okay, and then once they end up into claim, what will be the claim amount for each of them? So it won't be the same, right? The cost of a shattered screen is not the same as the cost arising out of damage from water, which is not same as the cost of a shattered back of the phone, right? So the amount of claims is also a random variable, and the number of claims is also a random variable. So this is the implication of modeling onto a general insurance contract, of the fact that this is short term business, okay, just 1 year of contract, and within 1 year it's not necessary that all the phones will be broken. See, if I talk about life insurance, it's issued to a person, a life, right? And if I talk about particularly a whole life contract, the person is eventually going to die. So on any policy there will eventually be a claim. We don't know when that claim will be, but it will occur. There is a certainty of that event happening, right? And when the claim occurs, we already have a contracted amount, that is the amount that will be paid. So under life insurance, claims are certain to occur, so you already know the number of claims, okay, and you also already know the amount of claims, right? On any given policy, there can only be one claim, and on any given policy the amount of claim would be whatever is the contracted amount, right? So that is known. But under general insurance, the number of claims on even a single policy is not known. What if someone in a given year lodges 3 or 4 claims? What if first their screen shatters, and then 2 months down the line their back shatters, and 3 months down the line there is a liquid damage? So in that case there can be multiple claims on a single policy, and the amount of all of those claims will be different. So under general insurance contracts, the amount and the number of claims is uncertain, and that is how these types of claims are modeled. Same applies for health insurance. You do not know how many times a person will be admitted to a hospital in a year, okay? You do not know what will be their hospital bill, because you do not know what will be the disease, which hospital they will go to, what will be the treatment which would be performed. So both the number of claims and the amount of claims is uncertain. That is a random variable, okay? Now let's come to CM1. Let's talk about life insurance. Similarly, let's say you issued 100 whole life assurance policies to lives aged 50. This is usually a symbol that is used to denote lives aged 50, okay, 15 brackets. It's also a symbol for selection, which we'll study eventually, but don't confuse that with this. Here it just means lives aged 50. So 100 whole life assurance policies are issued to lives aged 50. Now, and the sum assured is given as let's say $50,000, okay. Now what is the random variable here? The number of claims? No, because we already know all 100 will die. No one is immortal. People will eventually die. They will eventually make a claim, right? And the sum assured will be paid to all of them, right? Is the amount of claim an uncertainty? No, because we know whenever this person dies, the amount paid will be $50,000. So then what is the random variable? It's the time of claim, time of death or time of claim. So this is the only random variable under life insurance contract. When will the death occur? We already know the amount, okay. You can have claims where the amount also becomes an uncertainty, but that is also based on the timing. So you can say like if I'm simplifying this, if the death occurs within the first 10 years, the amount will be $50,000. If it occurs from time 10 to time 20, the amount will be $60,000. From time 20 to time 30, the amount will be $70,000, so on and so forth. You can define a contract like that, and in that case the amount of claim will depend on when the life dies. So that those contracts can be made. Those are called as contracts with increasing benefits, right? Those can always be made, but that is also based on the time of death, right? Everything depends on the time of death. So that is the only random variable, and using the time of death, you can model anything. And why is the time of death important? Because that will affect the present value of the benefit. If the person dies within the first year itself, you pay them $50,000, the value of that payment would be much higher than if you paid 50 years down the line, because if you paid 50 years down the line, the present value would be much lower, right? The discounting would be much higher, the time value of that payment would be much lower. So because the time value then is lower, it is important to model when the death occurs. So basically the only variable of interest under life insurance, the only random variable of interest under life insurance is the time of death of a claim, okay? And that is what defines our pricing and our reserving strategy.
Okay, now that we understand these differences, let me talk about one very important difference between these three contracts, that is the indemnity clause. Okay, and a lot of times in interviews for insurance companies, candidates are asked questions relating to indemnity, directly or indirectly. So let's try to understand what does indemnity clause in insurance means. The indemnity clause basically means that the purpose of an insurance contract is to put the person suffering the loss in the same position before the loss. Okay. So basically what this means in very simple terms is that the purpose of insurance is to make good or compensate the loss. Let's take an example. Okay. For example, you buy a phone that costs, let's say, $800. Okay, and you buy a 1 year insurance for it. Okay, so you have a phone that costs $800 and you buy a 1 year insurance for it. Let's say after 6 months the screen of the phone shatters. And the cost of the screen is, let's say, $300. Okay. So what will the insurance company do? Either the insurance company will pay you for your loss, that is $300, and you can take that $300 and you can get the screen repaired. That typically does not happen. They do not pay you directly monetarily. What they do is, instead they try to put you in the same position as you were before this loss occurred. What is the loss event?
The loss event is the shattering of the phone screen. Okay, so once the phone screen shatters, the loss event occurs, the insurance company will try to put you in the same position as you were before the screen shattered. That is, they will provide a screen replacement. And for that screen replacement, your mobile phone manufacturer, who will be repairing your mobile phone, will be paid $300 by the insurance company. Okay, so this contract will exist between you and the insurance company, and via the mobile phone manufacturer, the insurance company will make good your loss. So they will pay this $300, that is the cost of the screen repair, to the mobile phone company, who will then fix your mobile phone, and then your mobile phone will be in the position that it was before the screen was shattered. Okay, same thing can be true for all of these contracts. When there is a theft in your house, or when the contents of your house are damaged by a natural calamity, the insurance company will pay you a certain amount, the purpose of which is to make good your loss. Okay, of course there can be limits on what they pay, so they can say, okay, like let's say you have insured your house, the value of the house is, let's just say, $100,000. Okay, so let's say a loss occurred, and the loss was of let me take an example, $10,000, because the majority of value is of the land wouldn't be destroyed by any calamity. So let's say the loss occurred of $10,000, and you had bought an insurance which promised to make good this loss up to $8,000. So whatever loss is up to $8,000 because of theft or because of a fire will be compensated by the general insurance company. They won't pay more than 10,000 ever. Okay, so let's say I can take multiple examples here. Let's say the loss is in three cases. Let's say the loss is of $10,000 in one case, the loss is of $5,000 in one case, and the loss is of $8,000 in one case. So what will be the payout by the insurance company? What will they pay you? They will pay you a maximum of $8,000, because that is your insurance coverage. This is usually called as cover or coverage. Okay, so in this case they will pay you $8,000. In this case, the loss was only $5,000, and they don't want you to make profit out of a loss. The purpose of insurance is not for you to make profit. If you suffered a loss of $5,000, they will not be paying you anything more than $5,000. The maximum they can pay you is what you have suffered as a loss. So they will be paying you $5,000, with which your loss will be made good, right? It would be as if you did not suffer a loss, right? So the purpose of insurance is to indemnify your losses. Okay, that's the point. But in the case where your loss is 10,000, the insurance company won't be able to make your loss completely good, because your coverage is only up to 8,000. So you'll be paid 8,000. So in these three cases, this is how this is the cover that you will receive. Okay, or this is the payout or the benefit that you will receive. Okay, fine. So these are both examples of a general insurance contract. You can also take example of a health insurance contract, and for example, you fall ill and you are admitted to a hospital where the expense turns out to be, let's say, 500 pounds. So the insurance company will pay your medical bill of 500 pounds. Okay. Now, has the insurance company completely offset your loss? Not really, because if the sickness did some permanent damage to your body, which cannot be repaired, the insurance company cannot completely make good your loss, right? So they cannot fix your health. Insurance cannot reverse health damage. They can just pay medical bill, right? So if your medical expense was of 500, they will pay you this 500 if this is covered by your insurance, right? So they will indemnify your financial loss, but they cannot fix your health, right? So the concept of indemnity applies to general insurance. Definitely it does apply to general insurance, because they are able to completely indemnify your loss, because the nature of the contract under general insurance is such that the loss is only financial. The losses under general insurance are always financial losses. They can be reputational, but again that cannot be compensated by the company. Maybe they can monetize the reputational loss, and then they can replace that. They can convert, they can give you a monetary value of the reputational loss that they have that you have occurred, but mostly it's financial loss, right? And financial loss can be compensated, so indemnity applies. Okay. Again, under medical insurance or health insurance, the medical bill is paid by the insurance company. Okay, so indemnity applies again. Because they are indemnifying your financial loss that you suffered because of the medical bill. But the health loss, this cannot be compensated for, right? So here, you can say that indemnity applies, but with a certain caveat or a condition. Okay. In case of life insurance, let's say there is a person who has taken a life insurance contract for himself, and he passes away, and his or her spouse gets a monetary sum of let's say $50,000. Okay, I'm taking a hypothetical amount. Let's say someone buys a life insurance, whole life assurance. Whole life assurance meaning whenever they die, at the end of the year of their death, their spouse will be receiving let's say $50,000. Okay. So, does the concept of indemnity apply or not? Let's try to think about that. Are we able to, via insurance, make good the loss of the person or the spouse? Can the loss of life be indemnified? The answer is no. You cannot value human life. You cannot value the loss of human life. You cannot indemnify the loss of a human life. So, for example, someone's loved one dies and they had a life insurance contract, a whole life assurance contract of $50,000. The person is dead. Now they are receiving $50,000, but that won't bring the person back, right? That loss of life cannot be compensated, and they won't be put back in the same position as they were before their loved one died, right? Their position would be different. They will be $50,000 better off, and they can probably use that to manage their financial expenses, and probably if that member was an earning member of their family, then they can maybe live their life at the same standard. But the loved one cannot be brought back, right? The family member cannot be brought back. So that's why the concept of indemnity does not apply to whole life assurance or life insurance in general. Indemnity does not apply, okay? Because the loss of life cannot be compensated. They cannot be indemnified. So this is loss of life. Indemnity doesn't apply, right? Because loss of life cannot be compensated, thus indemnity does not apply. The insurance company just gives you an assurance that if this person dies and you are dependent on them, or you have suffered a huge emotional loss and all of that, we'll be paying you a hefty amount, or whatever is the amount of money that you have bought the insurance cover for, that will be paid to you. And that can just help you live a comfortable life, but then the loss of life cannot be compensated. So thus, under life insurance, indemnity does not apply.